Park Place Investment welcomes you to another episode of Investment Cubed, where we talk about the world of commercial real estate and real estate financing, Silicon Valley and technology startups, and investment and personal finance.
Hi everyone, welcome back to another episode of Investment Cubed. Today we have an amazing guest here to lend her expertise in the world of commercial real estate. Her name is Whitney Hutten, and she is the Director of Investor Relations and Operations at Good Egg Investments. Whitney discovered the power of real estate in 2002 when she became an accidental landlord and turned what could have been a failed investment into $52,000 in profits in 11 months. It didn't take long for her to learn how to leverage the buy, rehab, rent, refinance, repeat, and other flipping strategies in combination with creative financing to rapidly build her wealth and portfolio. Today, Whitney focuses on harvesting the cash flow and equity generated from her active portfolio to create multiple streams of passive income so she can spend more time with her family and create an impact in the world. Whitney graduated magna cum laude with a dual BS from the University of Oklahoma and a Master's of Public Health from Tulane School of Public Health and Tropical Medicine. She has headed operations development for national state government agencies, pharmacy change, and technology startups.
Hi guys, I want to welcome you to another episode of our podcast. Today we have Whitney Hutten with us of Good Egg Investments. Whitney, thank you for being on our show. I appreciate it.
Thank you. It's such a pleasure.
Great. Well, welcome. Thank you for coming. I appreciate it. Well, a lot of our investors come and ask us during our webinars and going through our platform on Park Place about the different financial metrics and the terminology that syndicators use. And they scratch their head and come to us and they ask us, well, what does this mean? Or what does the capital stack mean? I'm not really sure where I would be when I invest in this investment in the capital stack. So today we have Whitney on, and I really appreciate it that she wants to talk to us about some of this terminology, beginning with what a capital stack really is. Whitney, you want to take it from here and kind of tell our viewers what a capital stack is?
Yeah, definitely. Well, first of all, thank you for having me on. It's such a pleasure and an honor to get to speak with everybody here today. And, I'm the Director of Investor Relations here at Good Egg Investments. And so this is part of my job every single day, is working with our investor base and educating them so they're fully aware of the type of investment that they're getting into and just the true power of syndication investment. And so, naturally, Cam, I'm sure you've experienced, when you have a new investor or somebody maybe who's even seasoned and gone, oops, I really don't know what exactly I got myself into. They're really, or they're presented with this 100-page legal document, the PPM. They're like, I don't know what's going on here. So I really enjoy, one of my favorite parts of my job is just to sit down and help them demystify the power of what they're investing in, but also the legalese. So one of the things that I like starting off with is the capital stack, right? You have to understand when you're getting into syndication investing exactly what you're doing. And if I may, I'm going to share just a little graphic here. Let me switch slides. For the capital stack. So one of the things I like demystifying, first of all, is that some investors, when they start investing in syndication, they actually think they're investing in a note. They think they're lending money to the syndicator and that they're an expense to the bottom line, that they're going to get a dividend payment on their investment, like a bank. Well, when you get into a syndication investment, you're actually a partner. You're called a limited partner, and you're exactly that. And I like just saying, hey, listen, what I'm asking, Cam, if you're my investor, I would say, hey, Cam, we're partners. You're going to bring the money. I'm going to bring the time and the hustle, and we're going to share the profits together. So that's where it's really important for somebody to understand that what the capital stack is. And this is just a quick little visual. So the first part of the capital stack is it actually helps you delineate the risk, where your risk profile is in the investment and where your priority of getting paid back is. And as you can see here, the first two levels the senior debt and the mezzanine debt, and I'll explain what the difference between those two here in a second, that is actually the bank, right? And the limited partner is not the bank. Again, like I just said, the limited partner takes on a different position. They're usually going to be take a lower risk position or a higher risk position behind the bank debt, but lower risk in the capital stack. So they're going to be in the preferred equity position, or maybe even share in the common equity position. And they take higher priority of getting a capital distribution or profit sharing above the general partnership. So if we went through here, the senior debt, the primary bank loan has the lowest risk position, highest priority of getting their money paid back. Then should the general partner take out, say, like a refinance, or more importantly, a supplemental loan, like a second loan on the property, any sort of bridge debt known as mezzanine debt, that mezzanine debt is going to be in second position. So again, it's going to be a little bit higher risk than senior debt and a little lower priority than getting paid back. And that's where our debt line stops, okay? The limited partner is going to be in the preferred equity position or the common equity position, or a combination of the two. And so they're going to be, take a lower priority, they're going to have a higher risk position behind the debt, but a lower priority, in risk in the project compared to the general partnership. So that's just a quick visual of just generally what a capital stack is. Now, there's so many different flavors of this, and we can definitely dive into a couple that I see, in partnership structures, in the past couple of years that, maybe an investor could expect to run into.
Sure. That would be great. I just want to clarify, and I think some of our investors may not know that, that when you say equity, they're actually participating, and they're part owners in a company that buys that piece of property or fund. So that's really what an equity is, as opposed to when a debt is when a bank comes and loans money and they're expecting something in return, but it is low risk because they actually have the first dibs if the project doesn't go well, to be entitled to for the property. Is that correct?
Yes.
So is that the risk?
Yes.
Go ahead.
Yeah, and definitely, and the difference also will be noted. You can, when you go through the different financials as well, if as a limited partner, you're performing your due diligence, you could expect to see the debt as a line item expense, a below the line item expense in the financials, whereas the limited partner is even further down, and they're not an expense to the project. They are a partner in splitting the distributable profits on the property.
Exactly. That's a great point.
Yeah.
Very good. Okay. Do you want to go on to the next slide?
Should we? So here's a couple different flavors of capital stacks that you might see, especially in a multifamily syndication. So there's self-storage, residential assisted living, mobile home parks, all different types of syndications. But for in the multifamily space, I've been in the past couple of years, I've really been seeing two different types of capital stacks. One, what we call the single tier stack. And here, this is just an example. Perhaps the general partner has secured a senior debt on the property, and maybe the loan to value is about 70%. And then there will be two common equity classes behind the senior debt, maybe a class A and a class B. Now, class A, in the space that I'm in, we tend to see a 70-30 split of the profit, 70% going to class A, 30% going to class B. Now, here's the trick. There are also, I really like it whenever an operator gives a preferred return to that class A structure, okay? And the term preferred return, to me, I find a little annoying in real estate because it's really not a return at all. It just is a term that dictates who gets dibs on what part of the cash flow first.
Yeah. So for clarification, so Class A is for the limited partners or the passive investors, and Class B is for the general partner or the managers. So when you talk about 70-30% split is above and beyond the preferred return, which is the first dips is given to the investors. Above and beyond that, then any profit that's generated from the property or from the investment then is split 70% to the limited partners and 30% to the general partners, correct?
That's if that's how the waterfall is structured. Yes. And now we've just introduced an entirely different term into this model. And we can talk about that for sure.
Go ahead and finish your whatever you were saying, these train of thoughts.
Yeah. Oh no, definitely. Well, I just wanted to throw out just another tier structure, that I've seen kind of come into play probably in the past 1.5 to 2 years. And that is the dual tier stack. So here again, we still have our senior debt, low risk, high priority position. Now we have a preferred equity class, okay? And then we have a common equity class. Now Class A, Class B, both are gonna be your limited partner. Class C is gonna be your general partner. Now the difference between Class A and Class B in this preferred equity position, Class A is only getting a set amount of a preferred return. That's it. They're not participating in any sort of capital event or equity event. So and this is great for people who just want stabilized cash flow throughout the project. A preferred equity class might have, instead of, if the pref is 7% for Class B, the pref for Class A might be 9 or 10%. So they're forgoing participating in the upside on the project to get a higher month-to-month distribution. Okay. Now, common equity, Class B, this tier, I've seen they'll have, say, like a 7% preferred return, and they get to participate in the 70-30 split between Class A and Class C, or whatever that split is that the general partnership, puts forth.
Yeah, that's a great point, and I've seen a few of our sponsors do this, and I think it's a great way to kind of capture different types of investors, because an investor that wants, they want to be more kind of like almost like a steady cash flow from day one, but they really don't care about participating in the sale and gains from the capital gains from that property. They go towards more the preferred equity model, where they know they're going to get a cash on cash return every month or quarter or semi-annually, whatever the structure is, but they rather have that safety and not care about, they limit their upside, I think, right? Is that right? And with Class Bs, yeah, exactly.
It's a trade-off though, because remember, this is a stack, right?
Yeah.
If I'm sitting there as a general partner and I only have so much money to pay people back, I pay the debt first, I pay the preferred equity class, then I pay the common equity, and then if there's any left over, I pay myself, right? That's just a very stripped down, basic, oversimplified way of putting it. Now,
so Whitney, let me ask you a question on this. For someone that wants to participate in Class B, would they find an issue if there is a preferred equity? Because this echoes what you were saying, is because as you move down the capital stack, so I'm worried that, my cash on cash may be lower because the first people that are getting paid is, number one is obviously the senior debt, then it's going to go to the preferred equity. So I'm actually in this structure, I probably going to have a lower cash on cash return. Is that accurate? Is that something that a Class B investor would worry about?
Not necessarily. They're just taking a little bit higher risk position in order to participate in the upside.
Okay.
Now, here's the thing. This goes back to like the 3 fundamental ways that a limited partner can control their investment, and that is to 100% bet the operator, bet the market, bet the deal. That limited partner needs to understand who they're getting into business with. Do they know, love, and trust them? And this is like a whole other webinar that we can go through on how to vet operators. But that is, a solid operator that puts out a deal structure like this. Now, keep in mind, like the Class C, there are fees, okay, they're getting paid, but the Class C, the general partnership, is in it for the paycheck at the end. So they're not going to put forth a structure like this if they don't have a reasonable expectation that they're going to be able to meet that, right? Like, why would you go into business and cut yourself off at your feet and say, I'm not going to make any profit, but I'll pay everybody else?
That's a good point.
So,
you're right.
Yeah, crazy things do happen in real estate, though. We all know that. So.
Yes.
But yeah, these are kind of the two basic, two flavors of multifamily real estate tier stacks that I'm seeing these days. Now, what you just alluded to was the waterfall, and just a couple of quick points on this. The waterfall or this capital stack, plays into the waterfall. The waterfall just merely, outlines very succinctly in the PPM who is getting paid in what order. Okay. And then, again, like we've already covered, that just the limited partner, the investor really needs to understand where they are investing in the stack. I have so many investors that will, new investors that I work with, they'll come in, they'll get starry-eyed by the Class B returns. And then when they see the legalese document, they're like, whoa, time out. Like, why am I behind Class A? And I was like, okay, well, let's sit down and let's pick through this and really understand what all this really means. And then, we've already touched on it, when you invest as a limited partner, that's what it is. You're going into partnership in a business, and you're not a debt expense to the asset. You're actually splitting distributable profitable cash flow.
Mm-hmm. Yeah, that's a great slide right there.
Yeah. What other questions do we have? I can talk about.
Yeah, Whitney, thanks for that. Was a really good overview. Yeah. Now, I think these are really good points, and I think investors really should listen to this talk and really do their due diligence themselves, because every deal is different, it's structured differently, and part of that is understanding the waterfall and the preferred returns, which we talked about, and also the capital stack where they're at. There's some other terminology, if you don't mind just talking, because a lot of investors come and ask, well, this deal has this IRR, it has this equity multiple, has this cash on cash, and which one's more important? This deal has a better IRR and this other one. And I always try to educate them. These are all, first of all, these are all targeted IRRs or targeted numbers, and these are based on certain assumptions, and you still have to do your own due diligence. But even before that, do you mind just talking, what does an IRR mean? What is a cash on cash and equity multiple? And which type of investor should look for which numbers? Like if someone wants cash on day one, or someone that doesn't care and wants to sit on and they're okay with 5-year targeted exit and get their profits then. And that would be really helpful for our investors.
Yeah, definitely. So the cash on cash return is simply that. Like if I invest $50,000, how much cash am I going to get return on that on a monthly basis? Now, keep in mind, most general partners, they're going to have a pro forma, which, as you've already alluded to, is the best, an educated guess on how they expect the property to operate over time. Okay, so things happen. We had that happen this year. COVID happened, financial crisis, shutdowns, things. Yeah. There's all different types of things that can impact that business plan. Now, again, I don't want to go too far down this rabbit hole unless you have specific questions, but there's so many different ways that an operator, should be shoring up that business plan to take into account or be able to appropriately respond to these type of events. While we couldn't plan for this, they shouldn't be surprises, right? Operational, having enough large enough operating reserve account on hand, not overinflating your numbers, being very conservative under your underwriting, taking into account what the market vacancies are, not being too aggressive on underwriting your vacancy or your rent growth. All these type of things. But as far as like cash on cash, that's what you can expect to distribute to yourself, or distribute to the investor on a monthly basis or a quarterly basis, annual basis. Now, IRR is a little different. That is internal rate of return. Now, how that differs from annualized return. Okay, so on our particular investments at Good Egg, we're targeting a 20% annualized return on our investments. That's fine and dandy at all, but in that annualized return number, nowhere does it account for when you're getting your money back.
Yeah.
The IRR return, and I wish I had brought that slide with me today, because like when you see the actual formula of it, you understand why.
It's like calculus.
It is. It is very much a calculus thing. And I did a webinar on this a couple months ago, and everybody was like, "Do the math for us." I'm like, "And okay, here you go. There's the formula. Have fun, guys." But it takes into account when you get your investment back. So the example I like using is if I have an investment and I'd say you invest $100,000 with me, and I say I'm going to give you an annualized return of 25%. Are you excited about that or not? Most
25%.
investors initially are like, yes, I am. And I'm like, but I didn't say IRR. I said annualized return. That investment could run for 30 years or 40 years. You miss out on the opportunity of knowing when you're going to get your capital back. And that IRR takes into that account of when you get your capital back. So if investors are comparing investment to investment, the IRR tends to be the better number to compare, because it takes into account when your capital is returned. Now, you did bring up the equity multiple. Equity multiple is, let's take, for example, a deal that has a 5-year hold. In that investment, I'm essentially saying, what am I going to do with your capital? Am I going to exit? And that just means I'm giving you your capital back. That's it. Am I going to 1.5 exit? That means I'm going to grow it by 50%. A 2x multiple means I'm going to grow your capital by 100%. Okay. And so I think the darling child right now, especially in the multifamily syndication space, is to get close to that 2x multiple in 5 years. That's where, again, it's the darling child right now, a number to aspire for. But again, as you've alluded to, that's a great number for an operator to put in front of you, but you definitely have to perform your due diligence on that and really dig into the financials and make sure that the operator is being conservative in their underwriting and that there's reasonable expectations that they can actually achieve that before you invest.
Yeah, that's a really good point that you brought. And one point that you brought up is actually part of the due diligence process. The investors really have to look at how conservative it is, how much reserve they put, the sponsors, because if you don't put enough reserve and save for the rainy day, both for your capital expenditure and even like a 6-month reserve or a 1-year reserve for rents and your expenses, then I think those are really a lot more risky than somebody that promises, maybe under promises and overperforms. And I think that's a really good point. And those are really, and honestly, the sponsors that I've seen that are really have great experience and great results are the ones that actually are very conservative, because real estate over time will grow, and the only people that don't do well is because they don't have a good business plan, and part of that business plan is risk management. And I think you really brought that into light with the investors. You really look at what the business plan of the operator is before you dive in and just invest your money. And it's very interesting with IRR. When I started first investing, I thought IRR was annualized return. It's very hard because, in some of the other investment worlds like stock market, you don't really hear as much about IRR. So you think, well, if I invest and I get 7-8% a year, is that cash on cash? Is that IRR? What is IRR really? Is it what's net present value? What does it go in the formula? It is very complicated, but it is the industry standard really to compare deals, because it does take into account both returns and the time, which I don't think cash on cash and equity multiple do. But it is prone to manipulation, because I put in my IRR calculation, like an IRR could be vastly different in the 5-year span if you get the same returns, but depending on when those distributions are made, it could be very different, and it's very interesting how it's calculated. And for a land deal, a ground up construction, kind of like cash on cash is a moot point. So again, depends on the kind of deal you're getting into. Value added, is it a core, or is it more of a kind of a opportunistic like a land deal? Well, thank you. That's really helpful, Whitney. Really, that's a really good. But now, Whitney, let's switch topics and talk about Good Egg, because it's I've been talking to you before, and it sounds like an amazing platform and investment community. Can you tell us a little bit about Good Egg Investments?
Yeah, definitely. So we invest in the multifamily B class value add asset. We will do stabilized A every once in a while, but we're not it's still workforce housing. And so, our value add B plans tend to underwrite to 5 years, or stabilized A to 7 years. And, we look to invest in growing markets. So think Texas, Florida, and the Carolinas. We're looking to really stack all those investment cards in our favor. And, the returns on our projects, a little partial here, I feel are amazing, but, our core fundamental investment philosophy is to help people invest their capital, mitigate that risk greatly for them, generate monthly cash flow for them, reasonable expectations of appreciation. That way they can create cash flow for their family now and build wealth for the future.
Exactly. That's a great, and that's something the investors should understand, because, whenever they hear about syndications and they go, well, why should I put my money in somebody else's business plan, and why can't I do it myself? And you brought some states like Florida and Texas. Well, if an investor wants to find deals that are really good deals in those areas, good luck, because if you don't have a relationship with brokers, it's almost impossible to find something in a hot market like Tampa or DFW, Dallas-Fort Worth areas, or these hot markets. And for example, for California investors, I don't know whether they know or not, but everything's going towards migration of people follows with where the real estate is going to be hot. Like Dallas is hot, the Midwest, Carolinas, South, going down to even Tennessee and Florida area. And as an investor, I found it so much easier to use the expertise of syndications and syndicators such as yourself to invest, because you find the right deals, how to get the right loans, as we talked about in the capital stack, and bring back returns that are exceptional to the passive investors. And I think that's the power of syndication, as opposed to going out doing it yourself when you live thousands of miles away. You can't even find the right deal for it. I think that's a good point, well taken.
Well, and there's another return in here, ROT, that very little people talk about, and the return on your time.
What is that again? ROT, yes, that's
return on your time.
Like that.
And
that's a great point.
Yeah, I can share with your investors, if you, in the show notes or wherever, an article I just wrote on the 5 different ways that syndication helps you leverage your time. And, essentially you get to take advantage of a strong operator's knowledge, expertise in the market, expertise in the business strategy, their networks, their ability to get access credit and lending. And then you get to take advantage of other investors' money to take down these large, stabilized commercial businesses, okay, that you can, that have real value to them. I cut my teeth on single family investing. I still love the space. However, it's challenging because it's based on comparable sale. I don't have as many levers to pull to be able to actually affect the cash flow of that asset and grow my wealth. But in multifamily investing, I can do that by leveraging the operators and other investors' capital and knowledge and expertise. And guess what? I get back my time. And that is the most scary. It's your number one asset that you have. Hands down. Once you spend your time, you don't have any more. It's gone.
Exactly. Great point. I couldn't have said it better. Well, can you tell our investors where they could find Good Egg Investments? Can you tell us the website or
Yeah,
the social media.
definitely. So I'll just pop up this slide so you have my information as well. But yeah, so, again, I'm the Whitney Hutten. I'm the Director of Investor Relations at Good Egg Investments. You can find us at goodegginvestments.com. And also, if somebody would like to reach out to me directly, here's my email address, whitney@goodegginvestments.com.
Well, thank you. Well, thanks, Whitney.
Yes, you're very welcome. It was such a pleasure. Thank you so much for having me on today.
Yeah, it was great. Thanks for all the information you shared, and hope we could have you back on the show, maybe talk about some other things that we couldn't have enough time to talk about today. I really appreciate it.
You're very welcome. Thank you again.
You're welcome. All right, take care.
Bye.